So this is my take on de-risking biodiversity, whether that works or not, and what lessons we can draw from the energy transition regarding that. I'm a professor at the Technical University of Munich. We have a research team there that's called Public Policy for the Green Transition. So it's a very interdisciplinary team. We're about like a group of about 8 to 10 researchers now. And a lot of the work we do looks at how do we get the capital for the green transition or sustainability transitions at large. And nature and biodiversity is one part of this. We have a second group that is more policy oriented. So the Technical University of Munich has a think tank, which is called the TUM think tank. And I have a lab at this think tank, which is called the Transformation Finance Lab, which is much more kind of, engaging with policymakers and developing also formats of engagement, and not necessarily original research, but rather, I don't want to say translating research because I hate the term, but trying to figure out also in the first place, what kind of questions we should focus on in research that are relevant to policymakers. So that's kind of the setup. In terms of the content of today, I think on a very high level, and we talked over this at breakfast, is going to be a bit of like a bummer because this conversation about financing biodiversity or nature is in many ways a bit too simplistic. And it goes along the lines of, here's a global commons, right? Nature, biodiversity, we all depend on ecosystem services. So we have a global commons. We need to finance that somehow. And we recognize that we don't have enough money in public coffers. So the easy thing to do is we say, okay, we'll mobilize private capital. So there's large capital markets, right? It's like stock market capitalizations are very high. So like, here's a lot of private capital. We mobilize that for biodiversity. And then there is a reckoning of, okay, but a lot of these projects are too risky. So let's use public instruments to de-risk so we can draw in private finance. And that's about where the story ends, at least in my feeling in the policy domain. And then it's like, okay, so now we just need to figure out which instrument, and then it's fine, right? Then we can tap these large private markets and some money is going to flow to biodiversity and we have to solve the problem. Now that doesn't acknowledge, first of all, that, de-risking likely doesn't work in biodiversity because you need revenues to de-risk. That's in a very essential way. So why it worked in the energy transition is because you're selling an electron and nobody cares if you're selling an electron from coal or an electron from a solar panel. So you have a perfect substitute, and you're selling a perfect substitute into a market that exists and has existed for a very long time, as we have a revenue. And then you have a problem that, some parameters of that generation are uncertain, so you can de-risk. And the second thing that simplifies is that we just talk about biodiversity and we mean all of nature. And we don't acknowledge that actually what types of capital are applicable, how you finance will depend on what kind of ecosystem you talk about. So there are like two, I think, critical simplifications that are currently made. And I think under these simplifications, you might come to the conclusion that, yes, we can de-risk biodiversity. It's fine. It's going to draw in private capital. But probably they are too much simplification for the reality. Okay, so the agenda, we're going to talk about why de-risk in the first place, some lessons from the energy transitions. Then we're going to ask, what should we de-risk? How should we de-risk? And a conclusion. So why should we de-risk? So here is the international mandate on biodiversity that, depending on the background, some of you might know by heart, others might not know. So this is target 19 of the COP CBD, Montreal Kunming Accords, and it refers to finance in two ways. So it refers to mobilizing, and that's the mobilizing I told you before, at least 200 billion by 2030. So I would refer to this as biodiversity finance, a kind of a broad notion. And then it also refers to 30 billion per year that go from developed to developing countries. So a transfer logic. So we have kind of two finance goals in the international mandate. One is kind of broad, financial flows that can be anywhere, that can be, within the UK. And one is transfer. So basically money from developed to developing countries. And I think, so why I do this here is because I think the extent to which de-risking is applicable differs between the two. And we'll see later why. Why does it matter? Why should we de-risk in the first place? So some of that depends on geography. So where actually do we find biodiversity? So where, if we think of a very kind of first order way of financing. Where do we have to protect a site or reforest a site or uplift biodiversity? It's again very simplistic, but here is a map of biodiversity hotspots. And what you can see is that, they're kind of around the world. Here's another map from NASA on rainforests. Obviously, rainforests are concentrated in the tropics, right? So if you look at the actual institutional setting of these places and what that means for financing, then you'll see here, for example, you have Japan. So without knowing that you would come, I singled out Japan, right? And I'm just going to give you the country spread. So that's if you invest in a Japanese asset, how much above, a US asset class you would expect that to be in terms of financial return, knowing that, for higher risk, investors want to be compensated with higher return. So whenever you see a high premium, that indicates a high risk of investment. And that also indicates a high cost of projects because the access to capital is difficult. So that's Japan. And you can go on, that's Indonesia. Here we have Guinea. We're already at 13%. And then you can go to the rainforest. That's the Democratic Republic of Congo. Here's the Amazon rainforest. That's Brazil, right? The largest Amazon rainforest country. But then you already see the problem. So Amazon rainforest covers different countries, of course. That's Ecuador, that's Colombia, and there's many more, right? So what you see from that very simple overview is that you have the concentration of biodiversity, either if you think about hotspots or like a very simplistic way of thinking about biodiversity is rainforests, right, that are very rich in biodiversity. A lot of these places are in countries that don't have the same institutional environments than we have in, as let's say, OECD countries, and therefore incur higher financing costs. So that is something you can lower. So these financing costs, lowering these financing costs is the intent of de-risking, right? You can say one level further, okay, we have here Brazil has a risk that is somewhat elevated with respect to the US. But that is not just the only number you should focus on, because the second problem is if you raise capital, Brazil is maybe kind of an edge case. So Brazil has kind of a large economy, so they have domestic financial markets. But in many of these places, what happens is if you raise capital, you have to raise capital in a hard currency. So you have to raise capital mainly in US dollars, sometimes in euros, but mainly in US dollars. Now, if you take the example of Brazil and look at what happened to the exchange rate of the Brazil real with respect to the US dollar over 10 years, you see that so US dollar to Brazilian real was 10 years ago, 2.6. So for $1 US, you got 2.6 real. Now you get almost 6, right? So that's a factor of 2.5. So if you finance something over 10 years and you started financing it here, you earn your revenues in Brazilian real, but you have to pay your investor in US dollars. That's not just a premium of 4.4 you pay with respect to something in the US, but you actually pay much more if your currency devalues with respect to the US dollar. And that pattern of currency devaluation is something that we also have seen as consistently as higher risk premia. We've seen currency devaluation in many of these countries with respect to the US dollar, which again makes raising capital much more difficult because you have to factor in kind of an anticipated devaluation to be able to pay back, the loan, for example, that you're taking. All right, so geography is one aspect why we want to de-risk. A second aspect why we want to de-risk is we want to de-risk things that are capital intensive. Now, why and what do I mean by this? So here you have, and we're getting a bit closer to the energy transition and kind of lessons from the energy transition. So here you have the technologies, electricity generating technologies. In the energy transition, we transitioned away from fossil fuels to onshore wind and solar PV. And what you see is the cost structure. So this is lifetime cost. And you see the cost structure in terms of CapEx, OpEx, and the cost that you pay on your debt and your equity that you actually have to raise in the first place to be able to finance your plant, which is the CapEx, capital expenditure. And what you see is a very different CapEx to OpEx split. Obviously, fossil fuels are OpEx intense because you have to buy the fuel, you have to buy the gas or the coal that you're actually burning. Whereas renewables are not, because the sun and the wind are free, but you have to pay upfront, right? For biodiversity, at least I don't know, right? So we don't know the capital intensity of biodiversity projects. And it's absolutely crucial because to assess whether de-risking is even a tool that we might want to use, if what we're transitioning in the biodiversity is from an OPEX intensive to a CAPEX intensive solution, then de-risking is absolutely crucial. If we're transitioning from one OPEX intensive solution to another OPEX intensive solution, de-risking is not the tool here. So de-risking is a tool that is effective and important if we're transitioning to high capital or capital intense technologies. So this is the most extreme example. You transition from an OPEX to a CAPEX technology. Then it's really important, right? If you're transitioning from CAPEX intense technology A to CAPEX intense technology B, it's also important. But what you're aiming for needs to be CAPEX intense. If what you're aiming for is OPEX intense, de-risking is not the right tool. And just to illustrate how much this matters, here is a very stylized chart of a low means a low cost of capital, so a low risk country, and high means a high risk country. So think of low as the OECD country here, and high as to some of the countries I outlined before to you, where some of these biodiversity hotspots are. And what you see is here is lifetime cost of electricity in this example, right? What you see is the CAPEX intense technologies, onshore wind and solar PV, they are much more expensive in the high risk environment than the low risk environment. Whereas the OPEX intensive technology here, fossil fuels, it's about the same thing. So that tells you if you're aiming for a biodiversity solution that is CAPEX intense, this solution will be much more expensive in the countries I showed you before, as opposed to, for example, in an OECD country. And therefore, de-risking, basically bringing down this wedge here, de-risking can be an effective and important tool. So that was 2 reasons as to why to de-risk, so geography and capital intensity. Now let's have a look at some lessons from the energy transition and what we can draw from that. So here's a very complicated diagram that shows the energy transition in Europe, so for each country. Ignore the reference, maybe it doesn't really matter. It's just 2 different scenarios. You have emissions and you have costs. And you have 3 different model runs, for the ambitious and for the reference scenario. Let's just say you look at the ambitious and you see kind of a gray line where you have uniform cost of capital. So that assumes that, all these risk premia I showed you on whatever slide 2 or 3, where it was, they don't exist. So we're kind of in a socially optimal world where, capital is deployed at the same cost no matter where you are. And then you have a scenario where you introduce differences in these costs of capital, so where you get to actually a more realistic representation of investment risk. And then you have another one that's fine, where you also add learning. And basically, the difference here in CO2 and in cost is the difference between the uniform, kind of the simplistic world where everything costs the same everywhere, and the real world where, the cost of capital are actually such as I showed you in this map with the percent numbers. So you have different risk in different countries. And what you see is that in some, let's look at cost, maybe that's the easiest. What you see is that costs, start to look very different if you implement country-specific cost of capital. So for example, here, because that study, is a few years old, the costs of decarbonization in Greece are much higher than anticipated because the risk in Greece is much higher. And the costs in some low-risk countries like France or Germany are much lower than anticipated because the costs are actually lower than the model tells you. And so one of the big things we learned in the energy transition is that almost all of our energy system modeling was really off. So almost all of our cost modeling for the energy transition was really wrong because it was very well done on an engineering point of view, but it was very poorly done on an investment point of view because it assumed kind of a socially optimal cost of capital, which is good if you want to look at theoretically, like where should we invest most to have a cost-efficient transition. But it's really poor advice if you're looking at the real world and you're trying to think about where do we deploy renewables, right? And so that is actually a few steps away from, at least to my knowledge, where we are in nature and biodiversity. But I think it's one of the really important risks that we're facing if we look at where do we have to do something about nature and biodiversity in an optimal manner. And we will get to maps that you point to a lot of the very high risk countries. And we will get to these maps because that's where the biodiversity is. But we will not acknowledge in that the actual risk in these countries is much higher than in some others, which is why in reality, we're never going to see this. We're always going to see, a lot of these investments being concentrated in OECD countries, despite, the bang for the buck in terms of biodiversity being much higher elsewhere. But because capital basically is afraid of taking the risk. And so that's one of the big lessons we learned from the energy transition is the modeled costs were too high in the case of Europe, because the average discount rate we assumed in these models was above the empirical cost of capital we observed. Now, that's really the case of Europe, right? The model cost is too low if we're talking about Africa. So the second thing we learned is the model cost of the energy transition in Africa is much too low as opposed to what we're seeing in real life, again, because of the same problem. And the second point here is there is a lot of geographical misrepresentation because we're pointing to investment opportunities in place where there are no investment opportunities. It's just a theoretical like biodiversity or nature gain per dollar invested, but the risk associated to get this gain is so high that it's actually not materializing in the real world. Second thing, or another thing we learned from the energy transition is here is a chart of the cost of capital for solar PV and onshore wind. You don't need to be able to read this. It's over time, and what you see from far is it goes down. So it's not static. So what we've seen in the energy transition is that the cost that investors, or the return, I should say, investors demanded for a project became much lower over time. And it became lower because financial institutions actually learned over time. So experience matters. So first thing, you can expect it differ to like investment risk to differ geographically, and some of the biodiversity projects to happen depending on where investment actually can flow. And the second thing is you can expect that to change over time. So it's probably going to be higher now than in 10 years if you start doing these projects. So there's a learning effect. Now, here is a chart, a very simplistic chart of risk and return. So here you see the return and here you see the risk. So basically for an increased level of risk, every investor would demand is a super simple. This curve is not shaped like this in reality. For every increase in risk, you demand a compensation in return as an investor. So this blue line here is what's referred to as the market line. So every project on that line, finds an investor. Now, if you're A here, that is not being invested because the risk return combination is such that, investors are not willing to take that. Now, as a policymaker, you basically have two dimensions that you can change that, right? You can either increase the return or you can reduce the risk to get to the blue line, right? Or you can do something in between here. You can do both. And what we found, so this is a systematic review of the literature. I don't see my next slide series, so I'm going to have to do a bit of guessing here. So what we found in a systematic review of the literature for the energy transition here is very broadly that reducing risk was more effective than increasing returns. So policies that focused on the reducing of risk were more effective to draw in capital than policies that focused on increasing returns. And here I just give you a few examples of policy instruments. And I think, again, so not done for the biodiversity space, not sure if it works, but that's something one could do. So you can list policy instruments and you can think about how they impact risk and return. So for example, a carbon tax has no effect on risk because you're not sure what the price is in the end that you're getting on the carbon. So that's maybe a bit misleading. I should maybe write a carbon market here, right? So if you have a carbon cap, that would be a better term for that. You have a carbon price that forms from that cap. That price is uncertain. So you're not reducing the risk, but you're increasing the return, right? Now, take that to biodiversity. If you're building a biodiversity credit market, what you're doing is you're increasing the return. So for every biodiversity project that has a positive outcome, you get a bit more because you can sell a biodiversity credit, but you're not reducing the risk if the price of that one unit of biodiversity is uncertain, right? So that's an instrument that goes in this direction, in the increase return direction. If you have a guarantee, for example, so let's say a multilateral development bank guarantees you kind of a first loss guarantee, then you're reducing the risk, but you're earning the same return. So you can think about biodiversity in this and instruments to draw in investment along these two lines and try to kind of declinate through which instruments have an effect on risk and which have an effect on return. Now, why is the reducing risk here more effective than the increasing return? It's because of what I showed you on a previous slide. It's because of that capital intensity. So that finding is really specific to the energy transition because the energy transition involves moving from an OPEX to a CAPEX technology. And in that situation, policy instruments to reduce risks are more effective than policy instruments to increase returns. So that's the next slide. So here we have 3 timestamps. So it's a bit dated, but it was kind of the important time period for the energy transition. And you see the 5 most important risks in the energy transition and how basically they were ranked by investors in these 3 timestamps. Now, remember this chart from before where I showed you like increasing risk has to be rewarded with an increasing return. So if risk comes down, it's not just risk, but it's components of risk. So total risk here in 2017 was much lower as in 2009, but different risk components changed a lot. And so your risk is kind of a mix of technology risk. So technology risk here in this study we referred to as the risk of your wind turbine not performing at the level that you were expected, and resource risk, which is the risk at there not actually being the level of wind that you're expecting, right? So what you're seeing is that technology, policy, and to some extent resource risk actually came down as you learned. So you could assess the technology better. You were less dependent on policy. That's why policy risk came down in the last period. But other things like price and curtailment. So curtailment is basically how much of the electricity you're producing are you able to feed into the grid versus what is curtailed. So these risks increased because you're selling more to an actual market as opposed to a policymaker. So you're shifting away from policy risk to price risk, and curtailment risk becomes more important as you build out more renewables. So all of that then led to actually decreases in cost of capital. Here I just gave you the example of the UK because we're in the UK. Numbers don't really matter. It's just to show that these changes in the investment risk were reflected in the returns as before, like stipulated in this conceptual graph. And there is another way of conceptualizing that. So that's more for a developing country case now. That's UNDP, de-risking renewables framework that one could think about for the nature and biodiversity space as well. And we're continuing to work on that. You have a cost of equity and a cost of debt. So the 2 kind of sides of the cost of finance. And you have a business as usual and the best in class. And the difference between the business as usual and the best in class is, again, through interviews, associated to different risks. So you can have this kind of stacked waterfall chart of here, like different risk types, why we're actually for this project paying the rate that we're currently paying versus, a best in class. All right, so I'm going to skip over that and just give you the takeaways because then I have 5 more minutes for the second part, which is 1 or 2 slides, should be fine. So takeaway here, risk reduction was more effective than return increase for the energy transition. Geography and capital intensity matter. Risk, is not just risk, but it's components, and you can actually elicit these components. That's the one I skipped. There's different types of capital. So along this line of risk and return, different investors are interested. So what you've seen in the energy transition is that there is actually not a lack of capital available, but it was the wrong type of capital. So it was, for example, very large ticket size, very patient capital in the early stages. So you have a mismatch not in terms of quantity, but in terms of quality. And I think that's important. So to counter this argument that many players in the finance industry make of like, there's enough capital, you just have to bring me a bankable project. That's an argument I hear very often. Yes, I know there is, in terms of quantity, enough capital, but in terms of quality, there isn't, because it's not the right type of capital for the project we need. All right, and then the data is not available. So in the energy transition, how we worked around this is we were in touch with a lot of investors directly, getting project level data, both in terms of actual quantitative data and also interviewing them. Now the challenge here is, what if there are no investments? So we talk to a lot of investors as well in the biodiversity space. Everybody has gloomy dreams, but there is not really projects that you can talk about. So it's all kind of prospective talk. So it's very hard to do research on the topic. Let's quickly do the what to de-risk. Maybe actually, because it's a very similar slide, I'm going to go to the how. So here is my funky chart of an ecosystem and what you can do with an ecosystem, right? Where you could like deploy capital or de-risk something. So you can protect ecosystems or you can restore ecosystems. And there's been a bit of work on both. And both is extremely complicated for capital because it's essentially very hard to figure out what you're selling. Right? That's your points office, right? If you protect or you store an ecosystem, you have to afterwards sell an ecosystem service. And that is very complicated because ecosystem services don't have markets that are quantified. A lot of uncertainty around the price. Now, the other thing you can do is you can work on the pressure factors. And I think of like de-risking biodiversity a lot here. So either you can de-risk a substitute. So you can de-risk an economic actor that provides, develops a substitute for something that has a high pressure on biodiversity ecosystems. Or you should actually, and that's more kind of a policy idea, you should actually re-risk, not de-risk, but you should re-risk some of the activities. Here is an intensive cattle farm. Some of the activities that have very detrimental effects, so that you should substitute away. And here's an example from the policy space. KENFO is the German nuclear waste fund. So it's the largest publicly managed foundation in Germany. It owns 25 billion euros. And basically, the electric utilities paid these 24 billion euros that are now being invested. And the German government gets 300 million each year for like temporary storage of nuclear waste and decommissioning nuclear waste plants. So that's just a policy example in the re-risk space you could think about. A lot of our economic activities have detrimental effects on biodiversity. We know we have solutions of restoring sites after economic use. Nuclear waste is the most prominent one, and we could deploy that anymore. But how about de-risking substitutes? So two substitutes I always think about is one, synthetic biology, and two, food systems. And on both, there is actually pretty good, and very recent though, but pretty good overviews of kind of first level indications of what technologies are there, anyways, from big data to drones to kind of nano fertilizers, like in different sectors. What technologies are there that potentially alleviate some of these pressures, right? What has not been done is the next step from these technologies. What are the economic actors and what type, and that goes to the type, what type of capital do they require? What capital intensity are their efforts or their technologies associated with, and where are they located? And that would give you a picture of like the potential of de-risking biodiversity finance. So to end this talk, how can you come towards a framework of de-risking? What I think about is kind of a matrix with two axes. And one axis is the factors I've talked about that are relevant from the energy transition for de-risking. So how much revenue are you actually making with this endeavor? Where is it? What's the level of risk associated in the geography where you're actually either developing or deploying this technology? What's the capital intensity of the technology? And what's the type of capital that is associated with that technology at the moment? And you can go through different kind of archetypical ecosystems. Here is a forest, mining site, a forest or a wetland. You can be much more elaborate about these. And then think about for each, like to alleviate pressures here. On mining, you have 7 technologies. So that's kind of 7 additional columns here. And you go through these columns and you think through the factors that have been proven to be effective or have been proven to yield a situation where de-risking is effective in the energy transition. And you think about, okay, where can we actually do something about this? And moving away a bit from that space where it's really hard to think about how finance can play a substantial role. And then, you can interact this with policy and also from the energy transition literature. We have a really good example of different types of financial policy. So categorization, this is from a paper that I should cite here. that's from Bjarne Steffen, for four different types of financial policies. And you can interact this with, your ecosystem archetypes here to think about which policies can actually help to de-risk which types of biodiversity endeavors. So that's kind of towards a framework that I would think is useful for biodiversity de-risking. So key takeaways here. What does it require? It requires some sort of revenues. If you don't have revenues, don't think about de-risking, I think is a very basic thing. So that is applicable to a subset of biodiversity by definition. It's unlikely for that transfer finance that I showed you in the very beginning. So that from developed to developing countries. And it's unlikely, I think, for the protect and restore part of biodiversity, which is the vast majority of things we talk about at the moment in biodiversity. There might be high potential in that pressure reducing technology space, in first of a kind funds and public banks. So that's kind of two policy tools that have proven very effective in the energy transition. And here are some examples, and I'll leave you with that. Here are some examples for these three indicators. And with that, I think I come to the end of this talk.